Hello guys, welcome back. This is David. I do hope you're doing well. On to our next one now for current issues. Got the first two readings for you. Let's check them out. Now, our first one we have for you is Silicon Valley Bank, which is fast becoming a real kind of classic risk case study for all the wrong reasons, I suppose. Even though it's very much only a recent case that happened in 2023. Now, Silicon Valley, of course, implies venture capital. It implies the very famous J curve, as they talk about, or hockey stick, where capital is going to be raised from investors, but it might take a few years. Perhaps that's the start, guys, there. Perhaps year number 4 or 5. It might take a few years before capital gets deployed, and they've got to park it somewhere. Now, Silicon Valley Bank was very successful at attracting this kind of customer base. In fact, guys, half of all of the technology firms, VC technology firms, were clients of Silicon Valley Bank. Now, look at the growth of deposits from this market area, growing, guys, from 1983 all the way through to 58 billion from 18 million. And then even more so, 2021 tripling there to 209 billion. In fact, very untypically for many banks, but 94% of deposits not insured by the Deposit Insurance Corporation schemes. So one of the things we learn in FRM, guys, in liquidity risk, understand the nature of your deposit customers, understand the maturity, what they're using the funds for. This is a close-knit community, very concentrated, by the way, as well, in one kind of customer base as well, who are going to need to deploy their capital relatively quickly too. Now, what did Silicon Valley Bank do with the funds? It's in a way, it's a nice problem to have, all these deposits. And remember, guys, you've got these two dimensions to consider. Number one, liquidity. And number two, you've got the issue of returns. Now, of course, balancing these two is going to be tricky, but Silicon Valley Bank certainly didn't forecast much liquidity, didn't prioritize liquidity. They went for returns. And they chose long-term government bonds, being long duration, high duration, meaning they had a lot of interest rate risk. Also, guys, mortgage-backed securities as well too. So they did this at a time of historically very, very low interest rates. Now, taking that much interest rate risk and not hedging, by the way, either, proved to be disastrous for the bank. Because, of course, the shock rise in rates, sure enough, rates did rise from their very low levels quite substantially over the years to come. Meant they had lots of paper losses. These were classed as held to maturity that are not marked to market unless you sell them. So if you sell them, yes, then they will realize losses. Guys, rise in rates, fall in price. Now, Silicon Valley Bank then had a big irony in a way, from having excess liquidity initially to having no liquidity very shortly, but a lot of paper losses, a lot of real life losses. And their proportion of securities to total assets was way different from a traditional bank, more than double of an average large bank. Now, the picture changed from 2022 onwards with a net outflow of deposits. Guys, the venture capital activity fell, so not so much in terms of new money coming in. In fact, people want their money out, thinking about deploying the capital that was expected. Now, how are Silicon Valley Bank gonna accomplish this? Trying to delay and trying to encourage your customers to stay, not going to work. They want their funds out. Certain articles and certain events really spooked their customers, causing them ultimately to cause a bank run. First thing, guys, that's happening here, the Financial Times reporting the unusually high securities to asset ratio didn't help. The outflows continued as well. And then when Silicon Valley announced they had to sell 21 billion of their securities, realizing a loss of 1.8 billion on those long-term bonds. Well, that didn't go down well. Neither did the notice of potential downgrades from Moody's and S&P either. Now, you don't have to have a problem to have a problem, but if enough of your customers panic, then any bank has a problem if there's a bank run. And that's exactly what happened towards the middle of March here, March the 9th. That grew to 100 billion of our outflow requests. Guys, confidence was gone in Silicon Valley Bank, and no wonder the customers wanted their money out. Most of it was not covered by any kind of insurance. Now, what was happening, this reading here is not just about this part of the story. I'm also going to pick up on the supervisory side of the story as well. Now, the supervisors do have a part to play. They could have acted a lot earlier, but a number of things happened. The first thing that happened is that Silicon Valley Bank originally was classed as a regional banking organization, an RBO, and was due to be upgraded to a large foreign banking organization in 2018, but the threshold was raised. Now that had the effect of delaying. It delayed the bank becoming classed under the higher scrutiny of a larger bank. Some of the things that are discussed here are the lack of experience in not hedging their exposures, not having the right level of people involved, but also the supervisors here didn't do a good enough job in identifying these problems earlier. Now, this is the COVID era too. So in this particular period here, that they ultimately were upgraded to a large bank in February 2021. In the COVID era, where the supervisors had fewer resources, fewer face-to-face meetings as well, fewer regulatory scrutiny really, and it took until August 2022 before ultimately they were downgraded in their governance and in their regulatory approaches. So putting it all together, there's lots of kind of lessons learned from an FRM perspective. Looking at the criteria of liquidity versus return, they clearly chose returns and clearly didn't think or plan ahead for any contingency funding plan, didn't really plan ahead for liquidity as well. Also, not hedging interest rate risk at a time of historically low rates. Rates couldn't go any lower, but only go one way, and that was not protected at all. And it's ironic, isn't it, that to have so much excess liquidity to result then in not having enough, it shows that what they did with it was totally inappropriate as well. So guys, that's the first one. Let's check out the second one. On now to our second reading, Credit Suisse and the famous Coco wipeout. Okay, so we know that contingent convertible bonds are called COCOs, and COCOs really started to get a lot of press and market focus really post the crisis of 2008. And the reason is that back then there were a lot of bailouts. We think about the UK, for example, where I'm based. The taxpayer had to bail out a number of UK banks, and because of the mistakes made of the bankers. So this idea of having bail-in debt is really what a COCO is all about. So if you're have a COCO bond, effectively, you're lending money to a bank to receive quite a high subordinated yield. Now, this is quite a subordinated bond, so you're way down the ranking. You have to wait a long time before you would get paid. Now, the idea of being bailed out from within, bail-in debt, means that if the bank's ever in trouble, then COCOs would be one of the first in line to need to provide those funds. And it might be, guys, there that the bonds convert to equity, or are written down in terms of their principal values. And a key thing about COCOs to be aware of, guys, here, are the triggers are so important. So these triggers, what will the triggers be that will activate them? Two types of trigger, guys, mentioned in our reading here: mechanical triggers and discretionary triggers. Now, mechanical triggers are much kind of fairer and transparent and clearer, are defined capital ratios. So if your common equity tier 1 or tier 1 capital hits certain minimum levels, then fair enough, it triggers the COCO, and it might be convert to equity or writing down the principal. There's no debate or worry about that. Clearly, the trigger's been reached. But where it's a bit more kind of unclear, really, are discretionary triggers. And they use this term, very interesting term, point of non-viability, a PONV, which is a point of non-viability. And the point here is that who decides when a bank has reached that point of non-viability? Well, it's a supervisor or regulator that might decide. And of course, that kind of creates a lot of uncertainty about, did they do the right thing? Did they do the wrong thing? Perhaps people don't agree if that point has been reached. Let's bring in the case, which is for Credit Suisse and their COCOs. Now, this time of March 2023, we've already met the collapse of Silicon Valley Bank, 10th of March or so, 2023, and that created quite a lot of a contagion, I suppose, around the weaker banks, which other banks might also be having problems. In fact, many small banks were under a lot of pressure at this time. This pressure caused a lot of liquidity problems for Credit Suisse, and they were forced to request, look at that, guys, Swiss francs, 50 billion in liquidity from the Swiss central bank here, the Swiss central bank. Now, so the bank's in trouble. Now, what happened was, in this case, was the Swiss National Bank, the central bank, and one of the Swiss regulators, the Swiss Financial Market Supervisory Authority, they organised to take over a resolution plan for Credit Suisse. Now, part of the deal here was that 16 billion of the Credit Suisse COCOs was to be fully written down to add capital to the deal. Now, the end result of this worked very well. All right, so the market reaction, the extra capital, helped enormously to recapitalize the bank's balance sheet there. And in a way, most people were happy, with one exception. So the COCOs worked exactly as intended, because if you invest in a COCO, aren't you supposed to be there when the bank's in trouble? This bank was in trouble, and the COCOs had their value completely written down and valued to the tune of 16 billion. So guys, what's the problem? Well, of course, the problem is hold on a minute. What about the traditional? What about the traditional creditor hierarchy? Surely the shareholders should bear the brunt first, before the bondholders, because what's happened here is that the shareholders didn't really have any impact at all. It was the COCOs that bore the brunt, and this resulted in many other market regulators and commentators not being happy about the discretion used to trigger the COCOs by the authorities, and several lawsuits followed. So, guys, you can see the issue, guys, here that how do we know how it's going to work if you're a COCO investor, if it's not transparent and clear and detailed, if it's kind of the murky world of discretion? A lot more cause for future clarity. So guys, that's it for the first segment. See you back for the next one.